On September 26, 2016, Donald Trump and Hillary Clinton had their first presidential debate against each other. During the debate, Hillary Clinton inquired about Donald Trump's avoidance in showing his tax returns. In her inquiry, she stated that the few years of Donald Trump's tax records that were public showed that Mr. Trump had paid zero in federal taxes, at which point Mr. Trump stated, "That makes me smart." Let's take a look at that clip.
So you've got to ask yourself, why won't he release his tax returns? And I think there may be a couple of reasons. First, maybe he's not as rich as he says he is. Second, maybe he's not as charitable as he claims to be. Third, we don't know all of his business dealings, but we have been told through investigative reporting that he owes about $650 million to Wall Street and foreign banks. Or maybe he doesn't want the American people, all of you watching tonight, to know that he's paid nothing in federal taxes, because the only years that anybody's ever seen were a couple of years when he had to turn them over to state authorities when he was trying to get a casino license, and they showed he didn't pay any federal income tax. So if he's paid zero, that means zero for troops, zero for vets, zero for schools or health.
So Mr. Trump did not deny that he did not pay federal taxes. In fact, he states that not paying federal taxes makes him smart. Many people across America are upset and in arms because Donald Trump did not pay taxes. This isn't somehow something new. In fact, back in 2007, Warren Buffett stated that his tax rate was lower than the tax rate of his secretary. In fact, Warren's tax rate was almost half as the tax rate of all of his employees. Let's take a look at that clip.
There on the economy, we should say all of this comes with a looming tax fight in Congress. The Democrats want to revamp the tax structure and get rid of some of the loopholes that the wealthy and corporations enjoy to pay less taxes. And it may surprise you to learn that one of the universally accepted richest guys in the world, Warren Buffett, feels he pays too little by percentage. This interesting campaign of his was unveiled in a recent conversation with Tom Brokaw, who is here with us in the studio with more on this. This is fascinating.
Brian, it is well known that Warren Buffett is a contrary billionaire. Unlike most of his fellow billionaires, he believes that they should be paying a higher tax rate. And to prove his point, he decided to compare what he pays as a tax rate with what the people who work for him pay.
The taxation system has tilted toward the rich and away from the middle class in the last 10 years. It's dramatic, and I don't think it's appreciated. And I think it should be addressed.
You've gone very public with this.
Right.
You've talked about in your own office, for example, you pay a much lower tax rate with all of your wealth than, say, a receptionist does.
That's exactly right, Tom. And I think the only way to do it is with specifics. And in our office, 15 people cooperated in a survey out of 18. I didn't make anybody do it. And my total taxes, paid payroll taxes plus income tax, mine came to 17.7%. The average for the office was 32.9%. There wasn't anybody in the office, from the receptionist on up, that paid as low a tax rate. And I have no tax planning. I don't have an accountant. I don't have tax shelters. I just follow what the U.S. Congress tells me to do.
By now, many of you watching this video may be upset to know that the wealthy don't pay as much in taxes as the middle class does. Many people distrust the wealthy because they believe they are cheats. But what you didn't hear is what both Mr. Buffett and Mr. Trump said about paying less in taxes than everyone else does.
We used certain laws that are there, taking advantage of the laws of the nation. Now, if you want to change the laws, you've been there a long time, change the laws. But I take advantage of the laws of the nation because I'm running a company. My obligation right now is to do well for myself, my family, my employees, for my companies. And that's what I do.
I just follow what the U.S. Congress tells me to do.
They both use the laws that are in place, which allow them to reduce their tax liability legally. These are laws that are available to every red-blooded American. Contrary to popular belief, you do not have to be rich to take advantage of these laws. You just have to know them and then apply them to your financial situation. There are two caveats that you need in order to participate. One, you must be a business owner. As a regular wage earner, a W-2 employee, there are only a handful of tax deductions that are available to you, approximately 6 or 7. However, as a business owner, there are over 475 tax deductions available to business owners. Taking advantage of these lawful tax deductions will greatly reduce the amount of taxes you may owe to the IRS. The second caveat is that you need to become a long-term investor. Investment income is typically taxed at a lower rate than ordinary income. For example, someone who works and earns $100,000 in salary will pay approximately $30,000 in taxes, while another person who earns the same $100,000 but in investment income can realistically pay only $15,000 in taxes. That's half the amount of taxes paid on the same amount of money. That's the difference between ordinary income tax versus capital gains tax. The great news is that you don't have to be rich to start a business. There are many types of businesses that can be started for less than a pair of Michael Jordan tennis shoes. You don't have to be rich to start investing. There are many investment plans that you can start investing in for as little as $25 per month. Once you become a business owner and an investor, you too can begin to take advantage of the same tax deductions that allow Donald Trump and Warren Buffett to pay less in taxes than the average American. Stop complaining about the wealthy and start implementing the strategies that the wealthy implement. Regardless of what political party gets into office, the tax game will not change. It will always favor those who understand the rules. There's an old saying, don't hate the player, hate the game. However, the new saying is don't hate the player, learn how to play the game. If you're interested in learning how these rules can work in your favor, if you want to know how you can start a business,
Hey, if that's you, you're in the right place at the right time. So I know the information may be over your head. And I know the music in the background may be too loud. But for those that don't know, I am Chief T, active in the military, but I love sharing wealth topics and wealth tips that soldiers, civilians, and anybody that's interested can basically apply to their everyday life and position themselves for greater. So the video you just seen was former President Donald Trump. And for those that don't know who Warren Buffett is, I say go Google him. But you saw each of these individuals break down the fact that they pay little to no federal taxes every year. And they do that legally, ethically, and morally. And most people say that's the rules of the wealthy. But I'm here to tell you that that's not the rules of the wealthy. That's the rules that got them wealthy. But we all can apply the same principles, the same tax laws to our everyday life. So let's talk about this today. I say grab a pen and a pad because the information that we're going to be sharing is above the norm. This is stuff not taught in schools, for one, and this is stuff people don't want you to know because once you know it, you can apply it and you can become greater than what you are. I'm going to go through this, but for those that need to know who I am in a more in-depth, I guess you could say, study. Like I said, my name is Jason Thomas. Chief T is what they call me. I've been in the military actually for about 19 years, going on 20. And real soon here, I'm actually going to be approaching that 20-year mark. But what I couldn't understand was how is it that I'm going from promotion to promotion after promotion, making more money, but still not being able to see it in my check or in my household. And it wasn't until I got with an organization, a team actually, called Our Legacy Movement, who, in fact, led me to a company that we know affectionately as MWR Financial. Now, what's so great about MWR Financial? It's the ultimate cash flow company created by Mr. Brian House. Brian House, the CEO and founder, is actually this is his fourth $1 million company that he's created. So he created this company for the one mission of improving financial literacy, but also giving wealth strategies to those who haven't basically gotten it in their households and their families and things of that nature. And our president, Adamo Tosin, also in the field for over 20 plus years, partnering with Brian House. And together they are building an organization and a company that's doing things like no other. And I'll talk about that a little bit later. But the company is MWR Financial, so write that down. And the organization I got with is the Extra Digital Movement. So if you're talking about a hierarchy, think of the company NWR Financial as the umbrella, and the stem that you hold being Extra Digital Movement. We like to call ourselves the root because we are the root, and we have the most, I guess you could say, $1 million residual ring club earners. We have the most testimonies in this organization, and we continue to prove that our mentor, Mr. Brian Bean, is all about increasing and showing you how to create more cash flow. So look, he's been retired since the age of 22 years old. He's earned over $1 million, lost over $1 million within his first year in business. And now in his 30s, that was his 20s. Now in his 30s, he's showing us how not to lose the money, but how to duplicate the system and show other people how to become millionaires. He's the fastest and the most growingest business entrepreneur in our company, and he's helped over 100,000 people not only live a legacy, but also not just leave a legacy, but live it. So let's get into it. What is it that we need to know? Ladies and gentlemen, this is the cash flow quadrant explained and expressed by Robert Kiyosaki. That's another name you should probably jot down and go look at. But its understanding is that the left side is where most of Americans are, employees and self-employed. You want to move from the left to the right and become a business owner, ultimately an investor. And the reason why is this. On the left side, that's where you have the least leverage and you spend the most time trying to create dollars. Whereas on the right side, this is where you have the most leverage, and not only are you allowing your other people to create money for you, but you then turn your money to create more money for you, which in turn increases your cash flow. See, 95% of the people live on the left side, but 95% of the wealth is on the right. So you want to be on the part of the right side. So let's get into this. What are we talking about? First things you got to know the basics. And since there's a lot of people going to catch this on the live and a lot of people going to get this on the replay, understand that there's 4 roadblocks that we all have. I'm going to start from the back and work my way forward because that's what we're going to be talking about. But we're going to end up on our most, I guess you could say, the largest expense. But let's get to inflation. We all know what inflation is because we're seeing it every day. It's the cost of goods and services rising, but your paycheck staying the same. See, we also have big business. This is where you have all these companies. Not only inflation is an issue, but big business understand that cost of goods and services are rising, so they have to increase their costs too. But more importantly, they find a way every single month to have some type of spending holiday. I say spending holiday because not everybody celebrates holidays, but there is some type of spending uh, frenzy that goes on every single month. Think about it right now. Right now we have the end of May, but we have Mother's Day this month, and we have Memorial Day weekend going on right now. Next month we're gonna have Father's Day. You have Juneteenth as well. Then you go into August where you got back to school. Seems like we just got out of school. We're going back to school, so all the back to school the supplies is gonna be on sale. Then you go into Labor Day weekend where most people are supposed to be celebrating and having the day off. Whereas big business says, hey, we're gonna get you to come out, buy furniture, buy cars. That's when the things like that go on sale. And then we go into October, which is one of the biggest spending days of the entire year. That's Halloween. It's a $1 trillion industry, but it's celebrated in 1 month and specifically one day. But let's get to the second largest expense, which is debt. See, if you didn't have to pay for things you couldn't afford, you wouldn't have all that interest. See, most of us get into debt trying to pay for stuff that we can't afford right now. And the banks hit us over the head with interest. So you end up paying 2 and 3 times for something you should have only bought once had you had the money to begin with. And then the reason why all of the cycle starts is because of taxes, our largest expense. If you add up how much comes out of your check every month, FICA, social, medical, and federal taxes, and then you look at what you spend in taxes every single month, every single day, you got sales tax, property tax, ad valorem tax, you got inheritance tax, you got different type of gratuity tax, you got luxury tax. You have tax on everything that we spend money on, and when you total that up, that's a third of your income taken out. So let's dissect this. See, today we're talking about your money and the tax thing, the difference between tax deductions and tax credits. But we're also going to break down this Form W-4. But before we get started with all of that, I want to really dissect, because what you see on your screen right now is just the surface. What we need to get to and what we need to dissect is reading in between the lines. So to do that, I want to share this video, which we just saw. We just looked at the video. Uh, so let's look at it. You see this? We want to get deeper into the weeds on your finances. And to do that, you have to go in between the lines. And what do I mean by this? Well, let's take a closer look. A lot of people say the IRS don't tell us stuff, but here it is on the Form W-4, the form that you filled out when you signed up for the job that you currently have. And here's the IRS telling you that big refunds and big tax bills. This was back in 2005, ladies and gentlemen. Most refunds, the IRS was saying that 80% of Americans are getting refunds. And the reason why is because they're overpaying by a tune of $40 a week too much. See, most people think that if they get a huge refund at the end of the year, that's the best option. But really, the government even tells you that they're not going to give you interest on that money that you give them every month. So if you know that you're paying somebody every month and you're not going to get a return on investment, doesn't it make sense to put your money somewhere else? And it starts with the Form W-4. See, most people think they have to pay taxes. Really, the IRS tells us that you have to file taxes. And then they even tell you that, hey, this is where you need to go to adjust your Form W-4. And you need to do this not only once a year, but every time your financial situation changes so that you don't overpay who? The IRS. See, most people think it's their money, meaning the IRS, but really it's yours. This is the old 2019 Form W-4. Most of us can remember this one, but most of us don't know that this form has changed. I would say go back and look at your 2019 and actually read it and then put the numbers in. When I put the numbers in, ladies and gentlemen, what I found out was that I literally, my numbers total to 37 different exemptions. But in the military, we can only do up to 10. So let's get deeper. Here's another form. In 2018, this is the IRS telling us and telling you that stop overpaying us. And if you are getting a huge refund at the end of the year, maybe you need to do a paycheck checkup so that now you can start receiving more in your check so you can get out of debt faster, pay off your bills, and stop waiting till the end of the year to get a refund, which we know most of us don't do nothing but spend that on frivolous things, or we end up paying the debt that we owed anyway. Why not pay the debt off faster so you're not getting beat over the head in that compound interest throughout the year? So let's get to it. Can you see that? After filing tax returns, many people put taxes far out of their mind. However, taxpayers who received a large tax refund this year should think about taxes again, and sooner the better. The IRS urges you to do this. Doing so will help you keep more of your money in your check. See, most tax refunds are around an average of $2,800. $2,800. What could you do with that $2,800 throughout the year versus waiting to the end of the year? Taxpayers who receive a large refund could receive more of their money throughout the rest of the year rather than waiting until they file their tax return the next year. This is the IRS telling you this, ladies and gentlemen. So let's get it. stop leaving money on the table. What does that look like? So we're going to use two examples. We got Robert Refund and Miss Angela Adjustment. Robert Refund says, I'm not going to adjust my Form W-4 and I'm going to leave things the way they are. Where Miss Angela Adjustment says, I'm going to be smarter with my money and I'm going to get my money up front. Well, let's look at it. Take $500 a month that Robert Refund is paying in taxes. That's $6,000 per year. When you multiply that by 10 years, it's a total of $60,000 that Robert Refund gave to the IRS. Now you know you're not gonna see that $60,000 back back at the end of the year. You know you're not gonna see that $6,000 every year. So let's get into this. Ms. Angela Adjustment, she takes that same $500 instead of paying the IRS. She says, I'm gonna put it into a vehicle that's gonna earn me 8% interest. And she comes up with the same 10 years, $91,000. That's $31,000 more, and that she gets to keep that money versus giving it to the IRS. She's making money with the money rather than giving it away. Let's go further. The same $500 continued out for 15 years with Robert Refund. That's $90,000. That's $90,000. He still didn't catch up with Angela Adjustment within her first 10 years. Angela Adjustment continues the same rate, $15,000 per year at 8%. Now she's got $173,000. Do you see how much further along she's doing than Robert Refund? But let's take this out 30 years. This is most people's working career, right? Robert Refund has given away over $180,000 to the IRS, right? But Angela Adjustment, she says, I'm keeping my money, I'm making money with my money, and she's got $745,000 to her name. Not given away, to her name, ladies and gentlemen. See, you got to leave the simple world and join the compound world. The middle class gets taxed, while the wealthy defer taxes. See, we're not talking about tax evasion. We're talking about tax avoidance, deferring taxes, legally, ethically, and morally. See, a refund pays you back, but you deserve your money up front. That's over. Look, when you do the math, that's over $500,000 in some change saved and gained just by putting your money elsewhere and getting it up front. But let's go further. See, taxable income. We gotta learn these. Gotta learn these terms. Taxable income. That's the money that you make minus your credits and your deductions. This is called your adjustable gross income. Understand that. Write that down. Take a screenshot. All tax brackets are based on your AGI. That's your adjustable gross income, not your total income. This is not your gross. We're not talking about, hey, you say you make six figures and then they tax you off six figures. Everybody knows if you're making six figures, people that talk about making six figures, usually it's around $100,000, $105,000. Well, you don't get to see $105,000. No, you get taxed on that money and you really only come home with about five figures. But when you hear taxable income of $100,000, that usually means after the deductions, not before. So your tax bill, understand this, ladies and gentlemen, is always based on your taxable income or your AGI. Take a screenshot. And again, let me know what city and state you tune in from. Let me know if you catch this live on the replay. And let me know if you're getting value out of this. Hey, this is interactive. So if you want to join the room, let me know. And also, I want to interact with you. So type in the comments with any questions you have, and we can dissect it. So let's go further. Hold on a second. I went too fast. The IRS allows you to take the standard deduction. Most people don't even pay attention to it, but the IRS gives us free money every year. The past 2 years has actually gone up in the standard deduction. The standard deduction refers to the portion of your income that's not subject to taxes. So you make 100,000, the government says you can take out a certain amount of that 100,000 and not get taxed on that portion. So let's break this down in block 7. It says, so if your gross salary, meaning how much you made on paper, just the job you signed up for, they say you're gonna pay you $60,000 gross salary, and $15,000 of that was put into a 401k, and I'm not talking about a Roth, and they took the standard deduction off of that, that means you shifted your entire federal tax rate from a 22% tax bracket down to a 12% tax bracket. If the 401k contribution was pre-tax, that would even lower you even more. But we're about to break this down because I know words don't do much, but daggone the visuals do. So let's look at this. This is one of my business partners. I'm showing you what it looks like on paper. So he made $97,000, right? $97,000. But the federal income that he was taxed on was $25,000. Yeah, so he lowered his taxable income from 97,000 all the way to 25,000. He got a $15,000 refund, ladies and gentlemen, lowering his tax rate at the end of the year was only 3.77. 3.77. This is in 2015. Let's go further. Let's look at the state. The state, he made $99,000, right? But he was only taxed on 30,000, and he still got a tax refund of $5,000. His tax rate that year was 5%. You put the state refund in the daggone federal, and you're looking at a $20,000 refund check. Well, we like to say a rebate that year. He got a $20,000 rebate that year, right? Let's go further. This next year in 2016, he made $120,000, but lowered his taxable income AGI all the way down to $56,000. That's a effective tax rate of 9.83%, and got a $13,000 tax rebate. Now, most people they trying to get that $3,000, that $2,800. We're talking $13,000 in tax refund. But how do we do it? I want to give you a real world example, and I want to use one of my former business partners and fellow veterans. So let's talk about it.
Hey, good people, it's your boy Charles Ivory. I am coming for round two of this testimony. I am here with one of my business partners. This is Heather, and I want her to give you a testimony of being in MWR Financial. This is good. Hey, and for all of my business partners, if you're watching this live, I need you to tag all your Twitters, okay? Go ahead, Heather. What you got?
Well, everybody, I joined MWR last January. Went through the whole year. Unfortunately, I wasn't able to get any year, but I was tracking my business deductions and but what I did track taxes and almost $25,000 in business deductions. That's what I tracked. I work in the Army, and so my W-2 for the Army was around $60,000, $1,800 a year for taxes, and with the $25,000 deduction, I dropped my tax to $35,000, and I took the standard deduction, which dropped it even more to just over $17,000.
So Heather, you're saying you dropped your taxable income from $60,000 all the way down to $18,000. You put nobody in the business, but you were still able to claim 100% of your needs. You were still able to claim the 57.5 cents a mile that they gave us for driving last year. You were still able to deduct your cell phone bill. You were still able to deduct some of the clothes that you bought. Right. So what I'm saying is your income shifting anyway, but you're shifting money away from you. Most people shift money away from you. We show you how to shift your tax dollars back into your pocket so you can use those tax dollars to do investment. And Heather, speaking of investment, you did invest, right?
I did. I started up the private reserve account. I'll be a year in May.
A year in May. So now one of the first things that Heather did when she joined MWR Financial was get her tax dollars back into her pocket. So after you did the W-4 adjustment, tell me about the W-4 adjustment, what that did.
It was able to put, initially put $200 back into my I got $200, and then when they for us, and they were able to find some more deductions for me, so it jumped all the way up to $500 back into my account, or into my paycheck, which allowed me to set up a DRA account.
So instead of giving the government $500, you was able to put that $500 back into your pocket and invest it at double-digit rate of returns, by the way, and still get all your deductions and lower your taxable income all the way down to $18,000. Now, Heather, do you know most people, well, not most people, but a lot of people in our business will join us and then they will quit before they get to the finish line. So I congratulate you to get to the finish line because you won't be able to see the results of what this business can do for you and how income shifting can empower you until you get to the finish line. See, Heather, most people don't understand that there's two types of taxes, right? There's taxes for the have and taxes for the have not, right? Two types of tax laws. And when I talk about the haves and the have-nots, I'm not talking about the rich and the poor, but Heather, when you filed your taxes, you was able to file a Schedule C, which is the profit and loss statement. So even though she didn't put anybody in the business, she still won because she was able to fill out some deductions on the Schedule C, which is the profit and loss statement. So if you're with us, stay with us. Stay with us. Don't quit. Now, for all the quitters, hey, you can come back. We'll take you back with open arms. Because you got to get some of this. Remember, you're income shifting. You're just income shifting away from you. We're trying to help you shift the dollars back to you. Heather, man, that's an amazing testimony. And I'm so glad you shared this with us. And I know Jason Thomas is going to write this up for you so everybody can see it with the proof because we always document with proof. And this is an amazing testimony. Hey, I appreciate you. I tell somebody, let's make some money.
I'm working on it. I'm still working on it. I talk about it all the time. I just, yeah.
That's right.
I don't know. But I
Hey,
did
can
talk
you
about it.
imagine what your taxes would look like
I know.
if you would have made?
I know. Definitely got it environment for myself.
Right. But win or lose, we still won.
Yeah.
That's the power of the Schedule C,
Just
guys.
hoping to break even and I still come out of a little bit of
And
money.
you can still come out on top, right? Hey, you don't know what you don't know, but we can all learn to grow. This your boy Charles Ivory. I am signing out. To all my business partners, make sure you tag all the quitters and then welcome them back with open arms. It's never too late. Y'all be great on purpose.
Y'all be great on purpose. So, for those that's just tuning in, I am sharing a lot of information as it pertains to taxes, your W-4 adjustment, tax deductions versus credits, and using that money to position yourself for wealth. Today it's Financial Tip Friday, and I hope you're getting some jewels. Let me know what city and state you're tuning in from, and let me know if you're catching this live or on the replay. The bottom line is you have to take the information that you get and actually apply it so that you can do better. When you know better, you should do better. And the only way you can know better is by getting with some people that are already doing the things that you are wanting to do. So let's get back to the slideshow and let's talk about tax brackets. You know, before I joined this company and this organization, hey, Monifa, I never even knew what my tax bracket was, nor did I even pay attention to it. But let's bag back and then we're going to go forward. See, 2021, this was the income tax brackets. But slowly but surely, as we move forward in the new years, tax brackets have actually changed. But I want to quickly show you what Heather was talking about and what happened with her so you have a visual on what she just said. So she said she made $60,000 in 2021. Understand that we filed taxes the year after. So she made $60,000 total in 2020. She made $60,000 total in 2021, but she files taxes in 2022. And you also get your tax refund the following year, which was 2022. I'm gonna talk more about that in a minute. But let me show you how this works. See, we have a progressive tax system, so it doesn't just take, the 60,000 and you get taxed on it. It's progressive, and this is what it looks like. So, the first part of your $60,000, right, gets taxed. Well, between the 10% tax bracket goes all the way up to $19,900. The first part of her $60,000, right? That part gets taxed at 10%. Understand that. That part gets taxed at 10% first, progressively. Not all 60,000 gets taxed at the 12% tax rate. No, the IRS system is a lot better. So the first $19,000, because 10% tax bracket goes up to 19,900, gets taxed at 10%, which is 1990. Now the second part of that, 19,901 up to that 60,000 mark, that total amount is only $40,099. So that portion gets taxed at 12%, which totals $4,811.88. When you combine those two numbers up, that's how much you are owing in taxes. So that year, 2021, she owed $6,801.88. Understand that. $6,801.88. You could do this too. I would say go back and catch this on the replay and then go back, get your tax returns, and see if these numbers match up to what you got and what you paid. But let's go further. Heather also said that she did the standard deduction, right? So let's break down what that looks like, deductions versus credits. So you got to understand that credits, dollar for dollar, are higher, but there are more deductions. See, the video I played at the beginning, it said there are only about 6 or 7 different credits that you can get, where there's over 475 different types of deductions. So understand that. So let's take the same scenario. She has $60,000, right, that she made, and it puts her into a 12% tax bracket. It means that she owed about $7,200. About, if we just did 60, this is, now we're going into just straight multiplying the numbers. So if she did 60,000, you multiply that by 12%, you're going to get 7,200. Understand, we just talked about it. It is a progressive tax rate, but for this easy math and for you to follow, let's just do straight 60,000 multiplied by 12%, that's 7,200. All right. If you did a $25,000 deduction, understand deductions come off the top. Deductions come off the top. So instead of 60,000, you take away 25,000 from 60. That's $35,000. That still in the 12% tax bracket, but now if you multiply 35,000 by 12, that's only $4,200 in the tax bill. That saves her $3,000, right? But let's say she had credits as well, $2,500 in credits. Well, credits come off the bottom, not the top. Only deductions do. So let's just say $60,500, right? You subtract that or you multiply that by 12%. This should be 60,000, not 6,500. If you multiply that by 12, it's the same numbers, right? $2,500 come off the bottom. That means she only owes $4,700. That saved her $2,500. No, that means she only paid $2,500 in taxes. There's a $2,500 tax saving. She only paid $4,700. But let's see what she really did, because she did both. She had $25,000 in deductions. $25,000 in deductions, which brought her down to $35,000. And then she had the credits. So you take the credits out of the $4,200 tax bill that was due. Then she only owes in tax bill $1,700. That's a savings of over $5,500, ladies and gentlemen. Again, this is an error. Should just be 60,000, but she saved, instead of this 3,000, instead of this 2,500, she saved $5,500. But here, that's not even the end of the story. Let's talk about what really happened. Let's use her real scenario, because she said she had $43,800 in total tax deductions, right? Total tax deductions. So that lowered her taxable rate from 60,000 to 16,200, right? So it pushed her into a whole nother tax bracket from 12% to 10%. That brought her down from owing $7,200 to 1620. 1620. Huge. That was a savings of $5,580 just by itself. But she also said she had $3,944 in credits. So let's take that 16,200, 10% tax bracket, and let's continue the math. So her tax liability was 1620, but the $1,800 of the credits that she paid throughout the year. Understand this: she paid $1,800 in taxes throughout the year. That's what she said. She only paid $1,800 before she did the adjustment. So you do that, that's only $180 left that the government can get money from. But she had $3,944 credits. Credits come off the bottom. Let me break this down again. Look, ladies and gentlemen, all we did was go from 60,000, subtracted her $43,800 in total tax deductions, which is why we got 16,200. If we had stopped there, she would have owed only a 1620, which would have been a savings from this of 5,580. But she didn't stop there. She had $3,944 in credits from the IRS. So we got to keep going. So instead of 1620 being owed, we subtract also the 1,800 in taxes that she paid that year. Yeah, we could have subtracted from here too. $1,800 from the 1620, it leaves her with $180 left that she would have to pay in taxes that year. But because she had credits, she only is gonna have to pay zero, and she gets a check of $4,124. That's how much she got. But that's not the end of the story. That's $11,324 savings. Yeah, savings. Because look, she also got $500 per month with the W-4 adjustment that she was originally paying out in taxes every single month. So when you add that together, that's a lot of money, y'all. All I'm saying is, how much more money do you want to continue leaving on the table versus putting back into your check, getting yourself out of debt, and investing? Because at the end of that testimony, you know what she said? She put that money into a private reserve account, which grows at double-digit returns. So now she turned a simple strategy into a wealth principle that's been able to bring her back more and more dollars. But let's go further. Let's take this a little bit further. Because I want y'all to understand this, and I want you to get it. What she really got was a net profit of $4,124. That's what they paid her in a check. But total savings was $15,977 off a $150 a month business. Yeah, $150 a month business. If you're looking at $1,800 to bring in $15,977, I would do that every single time, every single day, every single year. Question is, will you? But let me give you another example, because that was 2021. 2022, the standard deduction went up. Look at that. It went up. So now you're able to take out more of your check and keep more of your money. Let me show you what that looks like. Look, from one year to the next, it increased. And then in 2022, my tax refund. Let's talk about my tax gain. So I made $72,000 last year, right? Let me use my numbers and show you what I did, because I got receipts. So you do the same. You do it the same way. You take the 10% off of the first $20,550, because that's what 10% tax bracket was for this year, right? You multiply that by 10%. That's 10,000. That's 2,055. Let's go further. There's $51,849 that exists between 20,551 and 72,400. So you multiply that by 12%, and you get $6,221.88. You add those two numbers, and my tax bill was $8,276 last year, right? That's what I would have owed. But let me show you what I did. So this is my income tax return, ladies and gentlemen. I don't have to hide nothing. Look, I made $72,400 last year, right? You got to understand taxable income, taxable income, tax deferred income, tax exempt income, and tax free. And we're going to break down the standard deduction and business deductions yet again so you can catch on what I'm putting down. So let's talk about it. Taxable income. This is usually the amount included in your income that's taxable unless it's specifically exempted by law. Understand that the income you make gets taxed. All reported income gets taxed. Income that is non-taxable may also have to be shown, but it's only shown for verification purposes, not necessarily being taxed. Let's talk about tax deferred. When something is tax deferred, these are like your investments. Your this is money that you pay into, but you don't get taxed on it until you withdraw that money, right? So any earnings, any contributions produced while the investment is growing is also tax deferred until you withdraw that money. Let's talk about tax exempt. A lot of people want to get there. This is income or transactions that are basically free from tax. You know, this is federal tax or state tax or local tax. Every government covering agent or jurisdiction determines what's tax exempt. Again, reporting what your tax-free income is uh, may be required, but it's not taxed. It's only for filing and information purposes. But tax-free, this is where certain goods and services are tax free and they're determined by the IRS. You know, these are like municipal bonds, things of that nature. There's a lot of different things that we could break this into. If you want details and different examples, I could break that down on another level, personally. But the reporting of tax-free items as well, they don't always have to be. They're not taxed, but they have to be shared when you're filing your taxes. But let's get into standard deduction. So for 2021 to 2022, the standard deduction is actually increased by $400 from single. And for married filing joint, it increased by $500. So figure out where you fit in, and that's where your standard deduction was. Understand if you made $100,000, if you made $50,000, find your filing status, single, married, filing joint, separate, or head of household, and that's how much came out of your income before you got taxed. Okay, at the end of the year. So for me, standard deduction was 12,950. But me, I was able to itemize because the amount of money I contributed on my Schedule A was a lot more than the standard deduction. I contributed to my local church over 13,000. So I was opted to take the higher amount, which was an itemized amount. The difference is uh, some people can itemize, and usually you know if you can itemize because on your Schedule A, and get with your tax professional. I'm not a tax attorney, I'm not a tax professional. I'm just a financial educator. There's no licenses behind my name except CW2. But understand, when you talk to your tax professional, they break down left and right what what works best for you and what gives you the ability to maximize your tax return. My tax professional basically said, "Hey, Jason, you did over the standard deductions, so let's give you the 13,911 that you are eligible to take." So my standard deduction was not higher than my itemization, so I took the itemized deduction. That's not to confuse that with business deductions. We haven't even gotten there yet. Standard deduction, itemization comes off the top before we even get to the deductions. So in 2022 to 2023, understand that the standard deduction has also increased, just like the tax brackets have expanded, so has the standard deduction. So in 2023, coming year, when you file tax in 2024, you're going to have a higher standard deduction. I mean, higher standard deduction. So instead of 12,950, you got 13,850. Instead of 25,900, you got 27,700. See, everybody got an increase. And that's important when you don't make a lot of money. But for those that are making buku cash in six figures, this number really doesn't do anything for you. But understand, if you're in the lower thresholds, this could be the difference between a bill paid and a bill going unpaid for the year. So let's get back into it. So what else did I do? I took my $36,000 in business deductions. So if you can, I'm gonna blow this up for you. Well, hold on a second. I'm gonna blow this up for you in a minute, but understand, I did $43,000 in business deductions, legally, ethically, and morally. But where do we get these business deductions from? See, the IRS says there's over 3 categories of tax credits, 10, 20 different types of tax credits, 3 categories. But the IRS says there's over 475 different types of tax deductions. See, you don't have to just believe what I say. I got the documents to support it. And so with those tax deductions with the business, here's what I got. And this is the app that I use. This is the one that we get free with my business. I had over 47,000 in business expenses. And let me show you what that looks like. The miles. Because I am a home-based business owner, the government says I'm going to give you mileage. I don't use this chart because this is what normal or most employees would need to use. Government says I can go further. The government says that because I have an office in the home, that I can use all of my, what we like to call the military in and around mileage. And so because of that, I can actually also do actual expenses. See, most people only know about getting, certain write-offs. They don't know that they can get the depreciation of their car, the license, the gas, the oil, the tolls, the lease, repairs, the tires, stuff you're going to spend anyway. As a business owner, specifically a home-based business owner, I can use these. This is where the $46,000, $47,000 in expenses comes from. Let's go further. Actual car expenses, and even Section 179, which says I could deduct the total price of the vehicle the year it was put in service. Yeah, so did you buy a car this year or last year? Did your tax professional tell you can write off the full amount of that car in the year that you put it in your business? Well, what about the depreciation? Maybe you missed that opportunity. Well, if you bought a car and placed it in service in 2022, you could have wrote off $19,000 of that vehicle. Say your vehicle was only 20, well, you almost wrote off the whole car. Again, you got once you know better, you can do better. But let's get to family employees. Did you know you can hire your family members? Yeah, and pay them a salary. Yeah, there's no child labor laws for family members when they work inside your home for your business. What about cruise ships? Do you take trips? Do you like to take trips? Would you take a cruise trip? Well, the government says you can write off that trip if it's tied to your business, pre-planned itinerary, and you got certain sign-in sheets that back up what you did. Yeah, what about the property that you buy? Desks, furniture. Look, this chart right here says you can write off up to 7 years worth of property. How many of y'all bought a desk or a laptop that you're currently using right now for your business and never knew? No one in your business, whether you're doing Mary Kate, whether you're going to live well or anything like that. Did they ever tell you can start writing off the full price or a portion each year for the depreciation of the assets or the vehicles that you bought to use for your business? Yeah, this is stuff we talk about in my circle. So let's get back to it. This is my profit and loss statement, the form that you use to write off and tell your tax professional what you would like to write off and deduct. Well, as you can see in the green box, I spent over $43,000 in legitimate business expenses, and because I had a profit of $7,000, I was able to write off $36,000 in expenses. See, it's called a profit and loss statement. This means as a business owner, you don't just get credit for the profits you make, but also the losses. So let's get closer. Look, man, take a screenshot if you want, but look at the expenses that I had. I did $342 alone in advertising. I did $9,000 in car and truck expenses. How much vehicle repairs, equipment expenses did you have last year? How much did you pay for a vehicle that you bought last year that you're using for your business right now? I paid about $9,000 for my vehicle last year, right? And then I had about $9,000 in expenses as well in depreciation for my vehicles, both of my vehicles that I had in business, right? And then I did over $11,000 just in mortgage payments and utility expenses. I had about $7,000 or $4,000, right? And then my favorite, which I was jumping the gun to, I did $7,000 in meals. How many meals did you eat out your home that you got credit for last year? And how much more money would you like to get back from the meals you eat outside your house this year? See, the government was giving 100% deductions for the meals I ate outside my home that was tied to my business. I had a lot of business meals, y'all. See, the tax rate on capital gains is also different. And we got to talk about this. Most people know wage income. But what if I told you your money making money for you will produce more tax advantages, but also will allow your money to compound a lot quicker? See, most assets held for more than a year, they go from 0% to 15% to 20%. And capital gains on most assets, you heard this earlier in the video held less than a year. Those are the only things that really get you in having to pay those taxes right away. So wage income, say you made $100,000 on your job this year, right? That gets taxed up to anywhere from 28 to 30%. So let's just round that off. 30%. That's $30,000 of $100,000 that you don't get to see. Yeah, you got a job that says you get paid six figures, but off the rip they already take $30,000 away from you. Whereas if you made that same $100,000 through investments, you would only have gotten taxed off 15% of that. So that means you would only have paid $15,000. That's a $15,000 savings right off that bat. But let's break down what all this combined looks like, because I gave you some examples, but I want to give you what it looks like on paper again, but in a different format. Look at these four couples. So you saying, hey, Chief, I'm doing fine. It's me and my wife. We got, two children, but I'm the head of the house and we're doing comfortable. Okay, that's cool. But let's look at what that looks like on paper and what those numbers really look like. So you made $70,000 last year, primary job. The government says in 2023 that they're going to give you a standard deduction of $27,700, right? So that means you get taxed off of $42,000, right? Which is still a lot of money. But let's say couple two says, hey, we're gonna do better. We needed more money. The $70,000 wasn't enough. Okay, couple number two, good. You went out and got more income, but you did it through a part-time job, which means both of those, the primary and your part-time jobs, gets taxed at the highest tax rate, which means you made $82,000, just like 82,000, which was more than couple one, and you got the standard deduction just like couple one, which is 27,700. But look, you got taxed off of more because you made more. See, the more you make, the more they take. There was no tax savings or no tax shield with what you did. You actually put yourself in a harder predicament on it from a tax perspective. But let's go to couple number three. Primary job, yeah, made 70,000 just like couple two and one, but they had a home-based business instead of part-time job. See, as a home-based business owner, ladies and gentlemen, you got to understand, a business owner, well, let's back up. An employee, they make the money, they get taxed off the money, then they pay bills, and then they get to spend what's left. Whereas a business owner makes the money, gets to spend the money, and then gets taxed on the money last. See, that's the difference. You either get taxed first or you get taxed last. Which one do you want? See, I'd rather get taxed last because they can only tax me off of what's left over. But as an employee, they tax you off the top. So instead of getting taxed off the top, they chose to get taxed off the bottom. They made the same 82,000 that couple number two made, but it's how you make the money. Still got the same standard deduction. So they was in the $54,300 income range, right? On paper. But then you take those deductions. See, they had $25,000 in deductions. Where did those deductions come from? All the stuff that we talked about in the last slide. So they lowered their taxable liability from $54,000 to 29,000. Look, they've already beat couple 2 and couple 1 just by having a home-based business, right? Let's go to couple number 4, because you remember I talked about those assets and investment strategies. So this couple did everything that couple number 3 did. Got the $70,000 in the primary job, got the home-based business, did the standard deduction, but here's where they did something different. See, remember when I told y'all that your pre-tax investments come off the top first, and you are able to use that money as a tax savings, a tax shield? Well, they put $12,000, the money they made in the business, they put that into an IRA. Instead of using it, they put it into an IRA. They deferred taxes even further. So now they lowered their taxable income than what the IRS told them to do to $42,300. And then the deductions of $25,000, the same deductions couple 3 had, come into play. So they lowered their tax liability, their AGI, all the way down from $82,000 to $17,300 by using tax strategies, a home-based business, and investment income. Ladies and gentlemen, when you look at this, understand standard deductions change every year, tax brackets change every year, but this principle, it doesn't change. So let's look at what it looks like. 2022 to 2023. Huge difference in tax brackets changes. You're going to get more money offered in the standard deduction. Again, if you're in a high income tax bracket, it really don't make a difference to you. But let's look at what we're talking about. Let's give you a different perspective on how to determine your tax bill. See, I guess you could say, you're using a head of household filer or using married jointly. All of these are done the same. You find out how much you owe. So let's just use mine. I had $72,400. So I'm in a 12% tax bracket, right? Well, you take the first portion of the tax, which goes up to, I believe it was 22.5, and you multiply that by 10%. You take the next part and you add the 1570 plus the 12% of what's remaining up to the 15,007 or the 22,000, and that's how you determine your tax bill. This is a different way. This is a sheet. Whether you having to do the math, basically you just come right here, find out where you're at, and you just add the numbers. But let's break it down, because this couple, they saved $2,900, but the tax savings that they got from couple 1 versus couple 4, 10% taxable income, $22,000 plus 12% of the $22,000. Hold on a second. That equals to only them saving. That equals to them saving $2,905. The slide's kind of broken, but understand this. What you need to get from this slide is that they paid less money throughout the year. They kept more in their check. They got pushed down to a lower taxable income, and their tax bill was annihilated. So we can go on and on and on. But I just want you to know there's savings out there for you, and you just got to start using it. Most people do not understand this game. They don't. Proof is in the pudding. The question is, what are you going to do with the information? You either want to save more of your money or you want to spend it. I'm available for questions. I'm available for discussions. I can show you how most people don't use these strategies, and I can show you how to get started. That's my time. I hope y'all enjoyed it. Y'all be blessed. Have a good day.